Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Leslie Picker in for Bob Pisani today. I'm joined by Bank of America's Bartels and ETF.com's Dave Nadig. Let's start with the markets. The S&P hitting a new all-time high on the heels of the G20 meeting. This just after the index closed out its best first half of the year in more than 2 decades. And the ETF business has been booming as well. $120 billion pouring into exchange-traded funds in just the first 6 months of the year. And the kicker is everything seems to be working. Both stocks and bonds are up significantly, seeing big inflows. So what does this say about the overall market environment, and what should investors do now? Dave, what do you think?
Well, I mean, when we see this, what we're really seeing is investors reacting to what happened still from the third quarter of last year. I think fourth quarter of last year, a lot of money came out of assets in general, went to cash. And when that money came back, it went into everything related to ETFs, stocks, bonds, even commodities. We actually saw inflows into gold for the first time in a long time. So honestly, everything seems to be working with very few exceptions. A few sectors like energy and financials haven't pulled in extra assets, but pretty much everything else has.
How long does the hangover from the fourth quarter continue to work, though, Dave? I mean, you know, we're already looking at 2 quarters beyond the fourth quarter. Does that steam ultimately run out?
Well, the thing about ETFs is there are already 2,300 of them. So if you don't want to be, say, in U.S. equities because you think this run may be coming to an end, well, there's a whole raft of short-term bond funds and gold funds and alternative assets that you can allocate into. And that's what we're seeing. So when we see flows into fixed income, often we talk about that being a risk-off trade. Not this time. We're seeing money come into the long bond and all the way into the very short end of the curve.
Marianne, what do you see as the driving catalyst behind such strong performance in so many different asset classes in the first half of the year? What is it that's kind of propelling those moves and that performance?
Well, earnings really drive stock prices. And when you look at the earnings growth rate from about a year ago, earnings are up 27%. Now, we've had a lot of volatility. There certainly has been trade tensions, and we've had concerns about a slowing down of economic growth here and overseas. And what that has caused is many professional fund managers to kind of keep some dry powder, to be very cautious on the markets. And our recent fund manager survey showed that the majority of global fund managers hold so many defensive positions that we haven't seen these levels of concern since the financial crisis of 2008 and 2009. So even though we haven't had a recession and we've seen stimulus from the Federal Reserve and earnings have been strong, the commitments to the markets just haven't been there. So we still think that there's a lot of capital that can enter specifically the equity markets.
You mentioned that capital. Do you think it does go into the equity markets specifically, or are there other asset classes that could continue to benefit from this? Because as you mentioned, there are certainly some geopolitical risks out there, and other people look at valuations in the equity markets as a risk in and of themselves. Marianne.
Well, what's also interesting is the valuation from a year ago. The PE multiple has also come down on the market. So you have had some contraction. Obviously, you've seen some moves in the gold market. Gold is coming off, but you have seen some assets go into gold. You've seen some assets for the first time in a while go into the energy space. But when we really look at all of the asset classes between bonds, stocks, cash, and alternatives, we still think that there's enough good valuations within the pockets of the market. Technology, for instance, which is also reaching a record all-time high, that we think you're going to start seeing assets move probably into the higher beta parts of the market, also what we call lower quality assets, because they tend to have a bigger bounce within the market.
Dave, what do you think investors should be buying, especially those that are repositioning their portfolios for the third quarter and second half of the year right now?
Well, I mean, I think it really depends on your perspective on this run. I sort of agree. We're in this weird situation where, yeah, the market's doing well, but earnings are actually outperforming the market. So I agree. I think there's still room to run here. In that case, I also agree we should be looking at those higher beta plays. What that means is likely moves into small cap stocks, into mid cap stocks, into some of the sectors that don't necessarily make the headlines every day. So out of FANG, say, and into solid mid-cap and small-cap consumer names.
Marianne, does that higher beta play increase an investor's risk profile at this stage, though?
Well, it definitely would increase the risk profile. So we raised our tactical target to around 3,100 if we would get some kind of deal with trade. We really didn't get a final deal, but we're in a space where the markets, we think, can tactically rally. S&P up near 3,100. But we're concerned that we're going to maintain volatility because we don't have a trade deal. We think these negotiations are going to take some time. We've been saying no pain, no gain. So the risk is that by year end, we're pretty flat on the markets or close to 2,900. So we are cautioning clients that we still think we're going to have positive gains, but you're going to see a lot of volatility around that. But in the near term, we think the higher beta part of the market will continue to rally.
All right, well, your mention of the trade deal is the perfect segue because there's not just a rally here in the U.S. Chinese stocks are also soaring after the trade truce, and our next guest says this could be your best chance to buy the group. Joining us now to help dissect all of this is Brendan Ahern, Chief Investment Officer at KraneShares. Brendan, explain to us exactly how investors should play the news from this weekend, because it does seem like, every week we learn something new. It's like 2 steps forward, 1 step back, 2 steps back. I mean, why is this now currently the entry point for investors?
Well, the truce that was struck over the weekend provides the opportunity for professional investors to come back into Chinese stocks. And professional investors have been hesitant to come into these names because of the trade war. That overhang has depressed Chinese equities. And we believe that going forward, the truce provides a great entry point, a great opportunity for investors due to the depressed valuations on both a historical and relative basis.
And you say that Chinese stocks have not been this cheap relative to U.S. stocks for the last 20 years. You haven't seen this differential between valuations in the two nations. Is it solely driven by these trade tensions, or is there something else going on that you believe is causing some of the contraction that we're seeing in Chinese stocks relative to U.S. stocks right now?
The major overhang has been the trade war, Leslie. You saw Chinese equities rallying in 2017 up through the first trade tweet at the end of January 2018. They've come down very, very dramatically after Buenos Aires in Q1 with a little bit of a trade deal coming. We had a very, very strong Q1. When the trade talks fell apart, we had a very poor April and May. So we think that trend that we saw in Q1 can come back into effect, that Chinese equities can rally back up to those Q1 highs.
Brendan, I think Dave has a question for you. Dave?
Yeah. I mean, Brendan, you obviously have a bunch of products that cover different parts of the Chinese market. Do you think investors should be focused mostly on mainland China stocks, Hong Kong stocks, New York listed stocks? Sort of which China do you think is poised to rally here?
Well, you're asking me to choose amongst my children which one I like both, but I certainly like I love K-Web, our China Internet and e-commerce, because of the very, very large disparity from U.S. internet stocks that we're trading at this massive discount. At the same time, KBA is our MSCI China A ETF, more of a value play with the backdrop of the MSCI inclusion of the stocks we hold in KBA coming not just in 2019, but in the next several years.
No.
Now, how about the state of the consumer in China right now? How have they been affected by some of these trade tensions with regard to some of the listed Chinese companies that have been suffering? You say it is a consumer-driven economy over there. Have consumers taken a step back amid some of the trade tensions that would impact the fundamentals of some of the companies that are in the ETFs that would be invested in with regard to China?
I think, Leslie, one of the points Marianne made was that strong earnings drive stock prices, but the overhang of the trade war has kept the Chinese internet and e-commerce companies, the companies that are the transmission for domestic consumption in China, they've kept them down. So that's why we really love KWeb today, because it's not just look at the non-manufacturing PMI we got overnight. It's still in expansion territory. Retail sales in the month of May was up over 8%. The earnings of the companies we saw from our portfolio, very, very strong. The Chinese consumer is alive and well. We've just had the overhang of the trade war. If that dissipates, I think these names, KWeb can go on a run here.
All right, thank you, Brendan Ahern. Marianne, I'm curious your take on this. Do you believe that some of the main
Thank you.
issues surrounding the Chinese stock market right now are related to the trade war, or are there other pockets of concern with regard to the earnings that you're seeing coming out of China, other data points with its economy that you see as potential headwinds for investing at this point in time?
Well, we've kind of had some data come out of China, some green shoots, just like Brendan mentioned, that are actually positive. So I think the trade tensions have really been a very large overhang for the markets. And when you do look at not only China but emerging markets, they're really at extreme depressed valuations. Now, this would be part of the market area that we call high beta, and we aren't expecting a trade negotiation anytime soon. Again, we think this is going to be long and drawn out. But for those investors that can take a very long time horizon and withstand volatility, taking a look at the emerging markets, which would include China, might be appropriate.
Perfect for patient investors. Wonderful. Thank you, Marianne. Now, let's end with energy, another sector that has been whipsawed by some of these trade tensions. Off its highs of the day as OPEC meets in Vienna, energy is still down sharply off its high, but it has made a comeback, a huge comeback in the last month. What is the best way to play this energy rally, Marianne?
So we specifically looked at the segment called oil services, and that's the sector that we think is not really benefiting. We don't think energy prices are sustainable to the upside, and we think that's going to hurt CapEx on E&P, that's exploration and production, and that tends to hurt the oil service pocket of energy. But if you want to look at energy and reduce your exposure to oil services, we'd prefer things like the XLE, which is the SPDR ETF, and Fidelity's ETF for energy, which tend to have lower exposure to the oil service.
Now, Bank of America cut its EPS and price objectives for oil services because of the potential underestimated risks in that market. What are some of those risks that you see right now?
I think one of the biggest risks that doesn't get talked enough about, Leslie, is that commodities have gone into a bear market. And what I mean by that is they've gone into a trading range that can last several more years. That means you get great rallies, but you also get great declines, and that the trend just tends to be flat. And I think the energy sector is the best example, because when you look at the performance of that sector relative to the market, it's the complete opposite of the technology sector. Tech is going straight up on a relative basis, and energy is going straight down. There's great companies certainly in that space, but we don't see any leadership characteristics. The supply dynamics of the oil market have changed dramatically, especially based on the technology here in the U.S. With fracking. So energy is not necessarily one of our top picks to be in the market, but if you wanted, again, to have that exposure, we think oil service gets hurt a little bit more, and you want to reduce that exposure. So you want to focus on the ETFs that have less exposure to the oil services, which I mentioned are the XLE and the Fidelity ETF for energy.
Dave, are there any pockets of opportunity that you see within the energy sector that you would point to in this current environment?
Well, we've actually seen an uptick in some of the alternative energy stocks, which I think is interesting. TAN is one that's on the solar energy, FAN, which is on wind energy. I think those are interesting sort of sidecar plays. I agree. I think this is a tough market for traditional oil stocks. I also agree that XLE is the way to play it here. You're getting much more exposure to refiners and marketers who really are just going to be subject to daily demand and not so beholden to changes in OPEC. I actually think there's a really interesting pairs trade opportunity here, going long something like that and just shorting out that exploration, production, and services business that may not do so well. That's a fund like XOP. So one of the great things about ETFs is you can use them to go both directions.
That is certainly one of the big benefits that institutional investors see in ETFs. That does it for this week's ETF Edge. I'm Leslie Picker. My thanks to Marianne and Dave for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.